Good morning, traders. It is Thursday, July 17th, and here's your daily market overview covering the US dollar index, WTI crude oil, spot gold, and Australian dollar. So, starting with the US dollar index, the dollar continued its upward momentum this week after the release of June's CPI report, which came in largely as expected but dampened hopes for a near term Fed rate cut. And traders are now adjusting the expectations, with most anticipating the Fed will hold steady at least until clearer progress is seen towards its 2% inflation target. And dollar index is currently trading near 98.5, marking a 2-week high, and is showing renewed bullish momentum. And after a period of consolidation, the index broke out of a descending wedge pattern, pushing above the key 98 level and reaching a 98.55 during the US trading hours. It is now approaching the 50-day moving average and the psychological 100 mark as potential next targets. And technically, momentum indicators are improving. The 14-day RSI has risen to 57, suggesting building buying interest, although the ADX still indicates the trend is in its early stages. An immediate support lies at 98, followed by 97.8. If bullish pressure continues, the 98.8 to 99 zone could be tested in the near term. And next, WTI crude oil. The oil traded around 65.6 this morning, slipping slightly as investors reacted to geopolitical developments. President Trump set a 50-day deadline for Russia to end the war in Ukraine, which eased fears of immediate sanctions on buyers of Russian oil. This softer tone from Washington helped cool supply concerns. And at the same time, a surprise rise in US crude inventories last week suggests a weaker demand, weighing further on the prices. However, stronger than expected GDP data from China could offer a degree of support given China's role as a major oil consumer. And technically, WTI is hovering near the 40-day moving average at 65.68. A break below the 50-day SMA at 64.88 could open the door towards June's low at 63.73. And now, resistance is kept at 66.75. The momentum remains mixed, with RSI near 46.5 showing signs of softening sentiment. Now turning to spot gold. Gold rebounded to 33.45 an ounce on Wednesday after 2 days of losses. While June's CPI report suggests rising inflation, likely tied to the new tariffs, the stronger US dollar and higher treasury yields have weighed on gold prices. Even as geopolitical tensions and trade uncertainty linger, gold has struggled to gain upside attraction. And still, longer term sentiment remains cautiously bullish. Traders are watching closely as upcoming data like PPI, retail sales, and labor figures that could shift expectations ahead of September's FOMC meeting. And gold remains range bound between 3,300 and 3,400. A break above 3,350 could open the way towards 3,400 and June high near 3,445. And on the downside, key support is found around 3,300 with further downside risk toward 3,257 if that level fails. The RSI has turned mildly bearish but remains neutral overall. And last but not least, the Australian dollar. The Aussie dollar rose to 0.6530 this morning, snapping a 3-day losing streak. Attention is now turning to Thursday Australian jobs report, which could influence the RBA's next policy move. A strong print may challenge the current expectation of a rate cut at next month's meeting, which markets currently see as an 80% chance. And Chinese GDP beat expectations slightly, but soft retail sales kept optimism. Meanwhile, US inflation and global tariff tensions continue to limit the Australian dollar's upside. And from a technical view, Australian dollar is showing mild bullish bias but remains under short-term pressure. The pair is currently testing the resistance at the 9-day SMA at around 0.6540. A breakout could open the way towards 0.6595, with further upside towards the November 2024 high at 0.6687. The support sits around 0.6510, followed by the psychological level 0.65 and the 70-day SMA at 0.6460. So that's all for today's market update. Stay tuned for more key data later in the week and trade with care. Thank you.